Let's get one thing straight. If your money is just sitting in a savings account, it's actually losing value. I know that sounds crazy, but it's true because of a little thing called inflation. Think about it this way. The price of everything: your morning coffee, a gallon of gas. If your money isn't growing at least as fast as those prices are rising, you're falling behind. Investing is your best defense against this silent wealth killer. It's how you put your money to work, giving it the potential to grow much faster than any high-yield savings account ever could. Now, let's talk about the magic of compounding. Albert Einstein supposedly called it the eighth wonder of the world. When you invest, your money earns returns. Then those returns start earning their own returns. It's like a snowball rolling downhill. The earlier you start, the more time your money has to roll and grow. Even small amounts invested regularly can balloon into a massive sum over decades. This isn't a get-rich-quick scheme. It's a proven way to build serious wealth and reach financial freedom. Imagine two people. One starts investing $200 a month at age 25. The other waits until they're 35 and starts investing $400 a month to catch up. By the time they both reach 65, the person who started earlier will almost always have significantly more money, even though they invested less. That's the power of time. It's the single most valuable asset you have as an investor. Every day you wait to start is a day you're giving up potential growth. Your future self will thank you for getting started today, not tomorrow or next year. So the goal here isn't just to beat inflation. It's about building a future where you call the shots. Buy a house, travel the world, retire comfortably, not have to worry about every single bill. Investing is the vehicle that can get you there. Okay, you're convinced. You're ready to buy a piece of a company. But how do you actually do it? You can't just walk into a Target and pick a stock off the shelf. You need to open a special type of account called a brokerage account. Think of a brokerage as a middleman. It's a company that has the license and technology to connect you to the stock market, allowing you to buy and sell stocks, ETFs, other investments. It's like a bank account, but instead of just holding cash, it holds your investments. This is your gateway to the investing world. Opening an account in 2025 is ridiculously easy. It's all done online and usually takes less time than it takes to order a pizza. You'll want to look for a reputable, low-cost brokerage firm: Fidelity, Charles Schwab, Vanguard. There are also newer app-based platforms like Robinhood, Webull. The most important thing to look for is zero commission trading. This means you don't have to pay a fee every time you buy or sell a stock, which is a huge deal for new investors starting with smaller amounts. The sign-up process is pretty standard. You'll go to the brokerage's website or download their app and click Open an Account. They will ask for your personal information, just like a bank would. This includes your name, address, date of birth, and social security number. Don't be alarmed by this. It's required by law for tax purposes and to verify your identity. This is all part of a government regulation called Know Your Customer to prevent fraud and money laundering. Your information is kept secure so you can feel safe providing it to a major established firm. Once your identity is verified, which often happens instantly, you'll need to fund the account. This is as simple as linking your bank account, your regular checking or savings, to your new brokerage account. You can then transfer money over electronically. You don't need thousands of dollars to start. Seriously, many brokerages have no account minimums, so you can start with as little as $50 or even $20. Once the money is in your brokerage account, you're officially ready to go. You've completed the biggest administrative step and are now ready to make your first investment. Now that you have your brokerage account funded, you're staring at the menu. What should you order? You'll see thousands of options, but for a beginner, it really boils down to two main choices: individual stocks and exchange-traded funds, also known as ETFs. Let's start with individual stocks. This is when you buy a piece of a single company like Amazon, Tesla, McDonald's. The potential reward here can be huge. If you pick the next big thing, your investment could multiply. However, picking individual stocks also comes with higher risk. Major problems: a scandal, gets outcompeted. The value could plummet. You've put a lot of eggs in one basket. To mitigate this risk, you need many companies across industries, diversification. For a beginner, managing 20 or 30 can be overwhelming. This is where ETFs are a beginner's best friend. An ETF is a bundle of stocks, sometimes hundreds or even thousands, packaged into a single investment you can buy and sell just like a stock. For example, an S&P 500 ETF holds stock in the 500 largest U.S. companies. One share gives you a tiny piece of Apple, Microsoft, Amazon, Google, and 496 others. Instant diversification. For most new investors, a broad market ETF is the smartest, safest move. You participate in the entire economy without picking winners and losers. Popular S&P 500 ETFs include VOO, the Vanguard S&P 500 ETF, or SPY, the Spider S&P 500 ETF Trust. Buying one of these is like betting on the U.S. economy to keep growing long-term. It's a set-it-and-forget-it approach. All right, so the moment of truth has arrived. You've got your account, you've transferred some money, and you've decided what you want to buy. Let's say an S&P 500 ETF like VOO. Log in. Use the search bar to type the ticker of the investment. The ticker is just a short code, like VOO for the Vanguard S&P 500 ETF, or AAPL for Apple. You'll see the current price, a performance chart, and big buttons that say buy and sell. Click buy. An order ticket opens. Don't get overwhelmed. The two most important things are the order type and the quantity. For your first trade, use a market order that buys at the best available current price. Enter the quantity. You can enter number of shares or, thanks to fractional shares, a dollar amount. If VOO costs $450, you can buy $50 worth and get about 0.11 shares. Select market order, type your amount, say $100. Click review order, then submit, and that's it. Congratulations. You are officially an investor. Your order executes in seconds, and you'll see it in your portfolio. It really is that simple. Now that you're an investor, you might be tempted to just check your account balance every 5 minutes. Don't do that. Instead, channel that energy into a little bit of learning. I'm not saying you need to become a Wall Street analyst or spend your weekends reading 100-page financial reports. For most people, especially those starting with ETFs, the homework is much simpler. It's about understanding what you own and why you own it. If you bought an S&P 500 ETF, remind yourself, you own the 500 biggest U.S. companies, and your goal is long-term growth. If you venture into individual stocks, research is a bit more involved, but still straightforward. Start with companies you already know and use. Do you love Nike shoes? Do you use Microsoft products every day? Are you constantly ordering from Amazon? That's Peter Lynch's Invest in What You Know idea. It gives you a starting point. Ask some basic questions next. Is this company profitable? Is it growing sales year after year? Does it have a strong brand people love? You don't need fancy tools. Most info is free online. Websites like Yahoo Finance or Google Finance are fantastic resources. Look up a ticker and get a snapshot. You can see its revenue, its earnings per share, and its price-to-earnings ratio. A simple way to judge cheap versus expensive. Spend 15-20 minutes on these numbers and you'll have a much clearer picture. The goal isn't to predict the future. No one can. The goal is to build conviction. Understand the business and believe in its long-term prospects, and you're less likely to panic sell. Your research is your anchor in a stormy sea. It separates daily noise and media hype from underlying fundamentals. A little homework goes a long way, from nervous speculator to confident long-term investor. The stock market does not go up in a straight line. Let me repeat that. The stock market does not go up in a straight line. There will be days, weeks, or even months when your account value goes down. This is completely normal. It's not a sign you did something wrong. Think of it like a roller coaster. There are thrilling climbs and scary drops. The worst thing you can do during a drop is jump out of the cart. Panic selling. Selling after a drop just locks in your losses. People who lose money buy high out of greed when everyone is excited, and sell low out of fear when everyone is panicking. Successful investors do the opposite. They see market downturns not as a crisis, but as an opportunity. Think of it as a sale. When prices go down, great companies and ETFs are on sale. If you keep investing your regular amount, you buy more shares for the same money. This is called dollar cost averaging, and it's incredibly powerful. Zoom out. Don't focus on daily, weekly, or even monthly moves. Over 50 years, wars, recessions, pandemics, crises, yet the overall trend is powerfully up and to the right. Markets recover and reach new highs. Your job is to stay invested, stay calm, and let the market do its thing. Ignore the noise and trust the process. Every beginner makes mistakes, but some are costly. Number 1 is trying to time the market, buying the absolute bottom and selling the absolute top. It's a fool's errand. Even pros can't do it consistently. Don't wait for the perfect time. The best time to invest was yesterday. The next best time is today. Just get in the market and stay in. Another huge mistake is putting all your money into one hot stock you heard about. That's not investing, it's gambling. A stock up 500% can drop 90% in a week. Don't chase performance. Build a diversified portfolio, primarily with low-cost ETFs. This protects you from a single company's failure. Boring is beautiful. The goal is to get rich slowly, not to get poor quickly. Mistake number 3 is paying high fees. Fees silently kill returns. Over decades, 1 or 2% can cost you hundreds of thousands. Start with low-cost index funds and ETFs, funds like VOO, VTI, with expense ratios around 0.03%. Practically free. Always check the expense ratio. Finally, avoid checking your portfolio obsessively. Daily fluctuations are mostly noise. Check monthly or quarterly, keep investing your plan regardless of market moves. Avoid these pitfalls: market timing, lack of diversification, high fees, obsessive checking, and you'll be miles ahead of most beginners. If there's one single idea to take away, it's the power of thinking long-term. Investing is not a sprint, it is a marathon. Real wealth isn't made in a day, a week, or a year. It's built slowly, steadily, patiently over decades. Your biggest advantage isn't a secret formula, it's your time horizon. Buy good investments and hold them for a very, very long time, letting compound growth do the heavy lifting. Think of yourself as a gardener. You don't dig up a sapling every day to check roots. Plant in good soil, water, give it sunlight, and have patience. Over years, that sapling becomes a fruit-bearing tree. This mindset helps you ignore headlines, see dips as opportunities, and frees you from needing perfect decisions. Invest consistently in a diversified, low-cost portfolio, then get on with your life.